what it seems like we're looking at in terms of how long it'll take for us to get a decision on this case.
With this particular judge, it seems like she's usually on the quicker side. No.
Well, no, that was the female judge is on the other case, the Florida MDL case.
Got it.
Right. This is a panel, so this has 3 judges on it, and they have it says on the order that it's going to be heard by Judge Rayo, Walker, and Centel. So those are the 3 judges that are hearing it. And remember, it's a panel of judges, so that means there's 3. So it could be a 2-1, it could be a 3-0, it's a 0-3. It could depend on how the judges are going to rule. It could be a split decision, but there will be a definitive decision on the issue by the end of the 30 to 90-day period.
Got it.
Yeah, everyone. Laurie, if I could just jump in here real quick and just add a couple of thoughts on the timing and maybe just a little more granularity on the standard of review that they're going to be applying, and then also provide maybe a little bit of insider's baseball background. I clerked at the federal level for a federal district court clerk, Chief Judge Louise Flanagan. This was about a decade ago, so I can help provide some insight as to how the judges themselves are preparing for the case, what they might be looking for, and as Lawyer of the Apes had said, how the questions that they ask will really frame their thinking to date on the case, and whether they're looking for confirmation or weaknesses in the cases that both parties are presented. So just to add a finer point, Lawyer of the Apes got this standard of review, of course, 100% right. But to translate that in practical terms, what that means is that just because Citadel or any other intervener or any other opining party has a different interpretation of the record that can equally apply, doesn't mean that substantial evidence therefore exists that the SEC acted without accord or outside of the boundaries of their discretion, which in this case is substantial. Really what it needs to equate to is that there's no rational basis for the SEC to have relied upon the evidence in the record to draw the conclusions that they did. So it would have to be an absurdity. It would have to be arbitrary and capricious, just something that they picked out of the air and decided that we want this to be our decision. And really what that is, if it was present, would be an indicia, an indicator of abuse, an indicator of agency, ulterior motives. So going through those ordinary procedural processes is critical, just as to really allow these agencies to exercise their substantial knowledge and familiarity with the markets. And one of the things that you saw relatively pervasively throughout Citadel's brief, if you read it, was that they kept saying that the SEC didn't address this particular scenario, or the SEC didn't address this particular eventuality. There's no requirement for the SEC to actually march through every single scenario or requirement or outcome. There's a doctrine of agency regularity, where if the agency is presumed to have knowledge of particular circumstances, and that it would be a given that that knowledge would be incorporated into considerations, that they could reasonably rely upon that unarticulated specific element of knowledge. Because if you imagine otherwise, it would just be this exhaustive, slippery slope of a process where an agency then just has to list every foundational assumption that goes into every single, and it's just an unworkable standard. So the standard of review that's here is extremely high. As Lawyer of the Apes noted, 95%. There are agencies who have 90% win rates strictly on the standard of review, because those agencies just have to defend with reasonable articulation that they had a basis for the rulemaking in the first place. Second, that I wanted to jump into real quick was the baseball, really the insider baseball aspect of what it is to be operating behind the scenes at the federal level for judges and clerks in particular. For those who don't know, federal judges, state judges, they all have clerks, which are recently graduated law students, or in some cases, career lawyers, who help them analyze and prepare for all their cases. As you all can imagine, their dockets are very full, and there's a constant stream, not just in terms of quantity, but in subject matter. This case itself represents a very complicated area that, in all likelihood, none of these judges has given considerable thought to before, let alone has developed sufficient expertise to actually be able to weigh in on. And that's where the clerks come in. They're young, at the federal level, very, very bright, and at the state level as well, very, very bright, recently graduated law students who analyze the briefs, pull out salient points, discuss these points with the judges, and prepare pre-hearing judges' briefs, where the clerk and the judge will decide, these are the points that I want to try and extract from the argument. If on the face of the papers, if on the face of the briefs submitted, there really are no salient issues, no material issues left, as lawyer of the Apes stated, the bench won't be that hot. There won't be that many questions because, frankly, there aren't that many questions left, and judges aren't in the business of wasting their own time. What'll be interesting to see is how they focus their questions. They might be completely silent on the SEC argument and then really dig in on the Citadel argument, which is in part what I would expect to see here. It seems like the SEC's case is relatively straightforward. They made reasoned consideration of all of the three different buckets of points, whether it's representation of retail, which obviously we'll get into more later, whether it's previous consideration of a substantially similar proposed rule, or this idea that it's the trades are not protected trades because the speed bump and in combination with the D limit somehow vitiates the SEC's prior analysis. The underlying point is that the SEC went through all of this. The clerks are going to identify, okay, this is where they made a reasoned conclusion. This is where they made a reasoned conclusion. If there's gaps in there, those are the questions that I would expect to see to the SEC. But I would expect much of the heat to be on the on Citadel and other, intervening here, advocating for petitioner's cause. But it should be an interesting case. And then in terms of timing, which was the last thing that I wanted to just touch upon, it is a bit of a black box. Judges go on vacation, and that holds up the whole thing. These are like real people behind the scenes. And so it's hard to dictate. There's not the same type of briefing schedule or judgment schedule as there is for the parties. So I think, as lawyer of the Apes suggested, 30 days would be a reasonable guesstimate. 30 to 90, you're probably going to fall in there. But there's nothing that says they have to do it within that period. They could do it as fast as 2 weeks if they think that this is just low-hanging fruit and something that they could just knock out, because here there was substantial consideration made by the SEC. So, but past that next stage, what would be possible is if once the decision comes back, let's say it's adverse to Citadel, the Citadel would be able to apply for an en banc hearing at the circuit court stage, which means instead of 3 judges, it would be the entire circuit judges. So I think it would be 7 judges sitting to hear a newly briefed case, and that would take another, let's say, 3 months. And then ultimately, if they wanted to, though it would be, relatively fatalistic to do so, they could file for cert at the Supreme Court level, thus dragging out the litigation and expense more. But again, if at this level, if at this panel hearing, the result comes back that the SEC has indeed made its considered judgment and exercised its agency role and authority, it's extremely unlikely that at the higher 2 levels, anything would happen.
That was a lot of information. That's a good thing. Information is good.
Sorry, yeah, right. I'm from New York. That's the way it goes.
That's preaching to the choir there.
Yeah, can you say all that one more time? I'm just now listening. Go ahead and repeat all that for me real quick.
Yeah, sure. Let's jump into it.
Oh,
so
no. I was joking.
403 years ago. No, but I think one interesting point that a lot of people might not realize, this procedure or this motion was started well before the January events. It's mind-boggling how they kind of jammed themselves up a little bit, it seems, in the regard that they're now trying to present that they're for retail, and that's kind of the crux of what their argument is. And we've seen, or in my opinion, not financial advice, do your own due diligence, trust but verify, make decisions you're comfortable with, and of course, hot pockets. We've seen otherwise, or I certainly feel I have seen otherwise. So the irony is not lost on me.
No, I think the section of Citadel's argument where they're representing relatively frequently that they are submitting trades to IEX during this brief window, and that those trades are on behalf of retail, but nowhere do they actually define what that conduct means. They don't define what on behalf of retail is, which actually gave me pause, because that could mean any number of different things. For instance, obviously it could be direct broker trading, but I was curious to hear others' thoughts as to whether there could be a more attenuated explanation and therefore less powerful explanation of this representation of on behalf of retail. Because for me, it seems that there might be an intermediary process, an internalizing process that could potentially dilute that expressed benefit that seems to be repeated often and frequently in the briefs.
I mean, I just think it's a disingenuous argument. I think that they're just, throwing, some flowery words out there, calling it on behalf of retail. And if you look at the Amici, they called them out on it. Better Markets and Healthy Markets called Citadel out on it outright in their briefs in regards to the aspect of them being an aid to retail. They use some pretty funny language, basically calling it, a ridiculous disguise, and the courts, hopefully will see through it. And it really is. It's just like this very thin argument, I think. But maybe from a technical standpoint, there is more to it, and maybe if Dave wants to talk about that.
Yeah, I mean, I found the argument equally absurd, as I've been pretty clear on online, and I mean, I just thought IEX did a good job of explaining it. Citadel is not directly routing customer orders to exchanges; it's buying shares for its own account and selling shares to the customer. I mean, that's how internalization works, right? So this isn't a controversial thing. I don't think it's a controversial thing to say that Citadel is not trading on behalf of retail. Citadel is trading on behalf of itself as it tries to make money from market making and internalization. So the fact that there is such a huge amount of volume executing in the milliseconds around every price change, and in fact, if you look at it, this isn't a consistent phenomenon across exchanges. It's dependent on the exchange fee structure. So, a lot of these arguments sort of start to fall apart as you dig into them. So, maker-taker exchanges will see, something like 50% or more of their volume executing around these price changes, whereas inverted exchanges don't, which tells you that it's about more than just sweeps and other explanations, that it really is about latency arbitrage. And I think that the more you dig into this case, the more interesting it gets, not from as Alex is explaining, the appeal itself is probably, likely dead in the water. It's hard to imagine they get past an arbitrary and capricious standard. And it's not really about debating the merits of market structure changes here, or, digging into the nature of latency arbitrage and how the delimit order might address latency arbitrage. That's not actually what the hearing, as I understand it, is really supposed to be about. It's more about the SEC process of review. But all of that being said, these briefs are fascinating because of how they do dig into this issue. And the fact that the SEC has come out and they've said, IEX has proven that there's latency arbitrage taking place on their exchange, and they have come up with a narrowly tailored approach to addressing that. to me, that's like an extremely big deal. I believe it's, one of the first times that the regulator has sort of acknowledged that this is occurring and that it's a systemic problem and that it's a big, enough of a big deal that an exchange can design and innovate around preventing that practice. So, that I think when I'm looking at it from a market structure perspective, that's a big part of what jumped out to me. I mean, this whole sense that Citadel is coming here and representing the retail investor, when Citadel's business and profitability from this perspective is based off of trading against the retail investor, right? Being on the other side of the trade. When the retail investor is buying, Citadel is selling. When the retail investor is selling, they're buying, right? That's a very big difference from trading on behalf of retail investors. Now, there is, of course, the time where Citadel doesn't want to take the other side of the trade and is then has to route that trade out to exchanges, ATSs, whatever it is. And, from that point of view, you could say that they are routing that order. I don't even know if you can say on behalf, but, they're trying to find that liquidity because they don't want it because it's not profitable for them. But even there, you could probably make the argument that that's still them sort of trading on their own behalf. Otherwise, they'd be taking the other side of it, and they're trying to avoid taking the other side of the order. So it's sort of in that avoidance, right? Yeah, go ahead, Alex.
No, I was just going to say, this is exactly what Citadel's brief is designed to do, is to draw you down into actually making an argument about the merits of the things that the SEC's considered. That is not this case, right? It's not ultimately for the judges or anyone else to decide. And it is fascinating, Dave. I didn't mean to cut you off in that regard. The briefs do, really reveal a lot about the thinking, or at least the way that they're trying to position themselves, both Citadel in terms of the narrative and the SEC in terms of the conciseness with which they're trying to knock each one of these down. But if you read the two briefs, what you'll see, and you have, but if people do, they'll see Citadel really tries to drag people down into the details of the correctness of the SEC's conclusions. And that's not what this is. And that's why I think, as Dave was alluding to as well, it's the standard of review is so high. The SEC just needed to consider these things. Citadel is trying to argue that the SEC's consideration was wrong. A party can't substitute their own judgment for an agency just because they don't like the determination of the agency. So today, in argument, what I would expect is for Citadel's attorneys to try and draw the judges into this was it correct? Was the outcome and conclusion correct? Because that's not what it is. It's really, did it even occur? Did the analysis occur? So I just wanted to peg that out there.
Yeah, and that's been eye-opening to me. Like, I didn't realize that going into this, especially as I read the briefs. And I mean, all I'm going to do is get sucked into the market structure argument. I'm not a lawyer, but it's that's how I see things. And so, from my perspective, that was the argument that seemed to be consistent throughout, and it was consistent throughout the supporting briefs as well. And so it was even there with like another major high frequency firm, XTX, filing a supporting brief and talking about latency arbitrage and talking about the cost of latency arbitrage. I mean, that's obviously what I want to talk about, and I think it's a fascinating topic. But at the same time, we can also get into this idea. I think people should make sure to understand that this is not an isolated thing on Citadel's behalf. And I don't know how many people are sort of familiar with the history here, but Citadel was aggressively opposed to IEX even becoming an exchange. They filed 5 negative letters, and one of them was about how IEX would harm retail investors. And they said they were a big participant on IEX, and that's kind of questionable in itself, certainly in the present. And so, I think Citadel has fought IEX every step of the way. And, whether that's because IEX does a good job of fighting latency arbitrage, as they claim, and Citadel is harmed by that, that's one possible explanation. I'm not endorsing that. I don't know that that's the case. I can't take a stance on what Citadel is doing and why and how they're making money, but they do seem to fight IEX every chance they get. And for something like this, it seems like they're more interested in delaying things as much as they can. And I think there are ways to look at this that are kind of surprising, but you have to think about it even from a market maker's perspective. If what IEX is doing will actually work, as IEX, the SEC, and other a bunch of other firms believe, and it leads to tighter spreads, that's not actually a great thing for a market maker, right? Right? Market maker doesn't want tight spreads; they want wide spreads. They make more money that way. So there are some kind of perverse incentives, I think, at work here as well.
Yeah, and those are really great points, Dave. And I just want to go back on one thing that I was thinking about, and also read something directly from one of the Amici, because it's just a really great line about Citadel. But when I look at this case and I think back to it, remember, this was all going on way before January even happened, right? This was before Citadel was even on, a lot of, retail investors' radars, right? We weren't all thinking about Citadel and what they may or may not have been up to. And it's so interesting to see, that they made these arguments and they sort of opened the door to the Amici to bring up points about them, about Citadel in general, calling them predatory. And I mean, abstractly, yes, were people aware of hedge funds and the fact that they were predatory? Yes, but not so specific as I think many people are aware today. And I think it opened the door and allowed, colorful language like this, which I really love in this brief from Healthy Markets. Citadel Securities undoubtedly excels at what it does, but it takes a breathtaking amount of chutzpah to claim that you speak on behalf of your direct counterparty in a zero-sum game. In other words, when Citadel Securities claims it is acting only on behalf of retail investors, it has all the gravitas of Sylvester the cat claiming innocence while Tweety's tail feathers are hanging out of his mouth. I mean, that's a great line, and I just love that image of it. I'm surprised no one's created a meme of it yet.
That needs to be a T-shirt.
Exactly.
Do you think that the veil of better execution quality is kind of being used as a Trojan horse for the byproducts of what is required for that execution quality? In particular, being that lack of latency to perform high frequency trading. The actual position of being so close to that latency does, in theory, provide better execution quality, but the other byproducts of that can lead to disadvantages for other members that are trying to create liquidity for markets. Is that fair to say, do you think?
So I think yes, I think it's a disingenuous argument to say that something like this will result in inferior execution quality for retail investors, given that the way the order type is structured is explicitly to protect firms who cannot compete on speed with the fastest firms out there, right? If you remember, Ken Griffin said in a recent interview that it's still the fastest firm wins. That means everyone else is losing, right? And that loss is an execution quality loss. It means that for example, you immediately get into a position where the price has moved against you. That's something called adverse selection, and it's a little complicated to get into, but that's sort of at a high level. It means that you're already at a loss immediately as you're in this trade,
right.
And that's a byproduct of latency arbitrage,
right.
And as I think I liked what XTX said at the beginning of their brief, that latency arbitrage can produce a series of costly consequences: less displayed liquidity, wider bid-ask spreads, and greater price volatility.
And you also get concentration within that, which when you have as diverse of a market that we have nowadays and the types of liquidity pairings that are generated, it does seem rather dangerous to have so much concentration residing in one market maker's capacity, if that makes sense, that you have somebody who not only is receiving a very large amount of what's going on, but the speed at which that they're able to access all that and also generate as far as liquidity goes, you only can have one winner at that degree when you're varying between nanoseconds at a time. To have somebody who is so on the ball with it In theory, yeah, it's a great thing, but the concentration that results of that, you're basically setting a cascading ripple-esque effect. If everybody else is generating their quotes or other pieces of liquidity from that, one person who is at the front of the line.
I mean, I definitely think, concentration is a huge issue. It's something that Gensler has pointed out a bunch of times now, and I think it's a good basis for which to have the SEC, start to look at these things, because it's very dangerous. It leads to less diversity, as you're saying, right? It leads to less market making diversity, and it's a real problem because that makes markets more fragile. That makes execution quality worse and market quality worse. That widens spreads when you start to concentrate huge portions of trading into one or two internalizers who are also the largest on exchange market makers and who also have a speed advantage over everybody else. That's a serious problem for markets.
Right.
And I want to underscore the importance of the SEC statements that the IEX had submitted substantial evidence around the existence of latency arbitrage occurring on the IEX exchange, and how D-limit would address those specific instances, though minor in time, relatively material in overall impact. The fact that the SEC looked at it, made a considered determination, and concluded that the D-limit would help address latency arbitrage is itself enough to overcome the burden of showing that this is arbitrary and capricious. So the discussion that you folks are having, which is reflected in the briefs to a certain degree, is itself the evidence that is required. The fact that 2/3 of the public comment during the notice and comment period were in favor of the D-limit shows that reasonable minds can differ on the import of each element of evidence being submitted. So all of these things, this conversation, its existence in the briefs, the extra brief materials in terms of note and comment, these are the things that the judges are going to be looking at. And I think based upon what I'm seeing, these conversations, it should be a relatively straightforward determination.
Just a quick update, guys. I'm watching the stream right now. The judges haven't taken the bench yet, but I will note that the stream usually, I'm looking at the last couple of oral arguments for the court. They usually get about between 200 and 1,000 views. Right now, there's about 3,200 people watching.
Now, do we think that's because so many people support the idea that Citadel is for retail and they want to just come support Citadel?
It must be.
It must be.
It actually underscores what has been so amazing to me over the last few months is just suddenly how many people care about market structure. And this is, you couldn't get more into the weeds than something like this. And an algorithmic order type that counteracts the cost of latency arbitrage, right? And yet, look how many people are here on the stream and listening into the court case. I just think that's so good. It's good for markets that people care and that people are interested, and I think it'll lead long term to some better outcomes.
Yeah, the awareness will not go back in the box, that's for sure.
Yeah, I think it's probably worth mentioning, because we call out firms when they don't do things that we don't like, that it's probably worth pointing out that Virtu filed a comment letter supporting the D-limit order type. In so much as Citadel will ever make a case that they represent retail, regardless of how true or false that is, Virtu will certainly be able to make the exact same case. They generally support changes and innovations in markets, and I think it's just worth pointing out that a similarly situated firm does not see the same problems, and I think it's interesting to wonder why, but I think it's a good thing to note.
And if ever there was needed evidence that there could be a reasonable differing interpretation of the impact of these rules, it's that. The two largest market makers having different interpretations, different positions, both presumably inherently reasonable, All the SEC is required to have its own reasonable conclusion, which aligns with 2/3 of the comments, including Virtu's. And again, that's why I think this is a relatively straightforward case for the judges.
So somebody just messaged me if we can kind of go over IEX's role. Lots of apes are confused. This topic seems to be delimits were made by the SEC. If somebody wants to just clarify that.
Yeah, I can talk about that. So IEX, just take a full step back. IEX is a stock exchange. They're an approved stock exchange in the U.S. And have been for several years. A firm that I've worked with in the past and have supported from the beginning because I believed in what they were doing. And exchanges compete against one another. It's very weird. The whole market structure around exchanges in the U.S. is very weird and confusing and complicated. So I don't blame someone for being complicated. Exchanges are what are called self-regulatory organizations. It's the only industry in which for-profit companies are also self-regulatory. So take that as you will. But what self-regulatory means is that it means that there is a part of each of these companies that is quasi-governmental. They're an extension of the regulator. And as such, they sort of get some deference from the regulator, and they get to do things that they can file things that are sort of immediately effective versus ones that the regulator actually has to approve. So that's an important distinction in understanding how an exchange designs and sets its rules. And the exchange has control over a whole lot of rules, and these rules set how the exchange works. It varies from fee structure, how much do you pay to trade, or how much do you pay to, or how much do you get rebated, all the way to order types and matching systems and order routing, because exchanges have to route their orders out when there's a better price on a different exchange, to market data feeds. There's a whole lot there that an exchange has to account for and build and design into their rule book. When they make changes to their rules, those changes are filed with the SEC, and those are called SRO filings, the self-regulatory organization filings. So an order type that IEX comes up with is filed as an SRO filing with the SEC. It's important enough that it's not, I guess I'd have to double check. I wouldn't have thought it's immediately effective, so it's something the SEC has to approve, versus traditionally, for example, fee structure changes have been considered immediately effective. That has actually started to be challenged pretty effectively too. But small changes can be considered immediately effective. Large changes, like a new feature, a new order type, has to be approved by the regulator. I do think it's important to kind of point out here that given latency considerations and market complexity and the sort of perverse incentives at work in the maker-taker fee structure, and the latency race to zero, generally exchanges are innovating in ways that are focused on fee structure and speed. And that is true sort of universally. It doesn't mean other things don't happen, but it means, generally speaking, most innovation in the exchange space is focused on adding complexity or reducing speed. And IEX generally has been pushing in the other direction, which is that they are innovating in different ways. They are coming up with novel order types. They are putting a speed bump in place. They're not paying rebates. They don't have complex fee structures. They don't charge for market data. Every single thing that I just listed there is really completely different from other exchanges, and it's generally a question of incentives, where IEX is not publicly traded and has been funded mostly by asset managers. Of the other exchanges are publicly traded for the most part, and generally focused on their biggest customers, which are the high frequency trading firms who do the most trading and therefore generate the most revenue for them. because that explanation was so shocking that everybody had to take a moment.
Yeah, I'm still collecting myself after that one.
I think the nature of the beast is there's so much information in this that it's like, as people hear it, it's digesting. It's not, we're not reading Sun Tzu, The Art of War. We got to read the same sentence 42 times, but there's a lot of information out here.
So I guess if you had to like condense this into one, like a TLDR kind of, a too long didn't read, what would you say is being argued today? What's the one-liner for this, and why does it matter?
I think in terms of the court argument, it's, I think as Alex has said, it's really going to be, did the SEC do its homework? And, it's hard for me to see that the answer is no. I agree with him. It seems like a slam dunk.
Yeah.
I do think that Citadel will try to change that subject because that's not a winning argument for them. And they'll try to say, but look, we represent the retail investor and this will damage retail investors. And they'll try to appeal in that way to, all sorts of different sentiments maybe that the judges might hold. But, in reality, it's probably more of just a delay tactic than anything else. And don't forget this, there's sort of a massive conflict of interest underlying all of this, which is that Citadel and Virtu recently funded the new Memex stock exchange. And, so they have funded a new stock exchange. They are, responsible for all this order flow. They try and, maintain the status quo of payment for order flow. But if it all falls apart, they're sort of ready with the stock exchange. And so, if they don't like something on another stock exchange, there's certainly a conflict there. It doesn't mean exchanges don't fight each other for changes or to prevent changes, but it's
Right.
not. I don't think it's something a lot of people are talking about right now either.
There's like a market within the market, which isn't so outlandish to think of if you're from within the realms of what's being talked about within this contention. But the structuring of fees and the structuring of rebates all are this own living, breathing system that exchanges and different broker-dealers and other just market-making entities all are adapting to based on those structures of fees and rebates. Is that fair to say?
Oh, yeah. I mean, the fee structure complexity is really absurd. And, it was so absurd at one point that the SEC didn't even know what it was when they were trying to structure the transaction fee pilot. And they started to come up with, rules that these structures had to be disclosed in a machine readable way so that they could have a computer try and figure it out because they couldn't figure out the complexity. And there's massive conflicts of interest baked into exchange fee structures. I mean, that's just, it's turtles all the way down on Wall Street. It's just conflicts of interest all the way down. And, so the exchanges use fee tiering to reward firms that send more order flow to that exchange, which perverts order routing practices and makes brokers route not necessarily for execution quality, but for fee minimization or rebate maximization. I mean, it's and there's no real best execution enforcement because, as FINRA has said in the past, trying to enforce best execution is like trying to staple Jello to a wall. So everything, it's all conflicts all the way down.
Right. Are you familiar with the NYSE liquidity retail liquidity program?
Yeah, I mean, I've read about it when they were implementing it. I was reading the SRO filings.
Yeah, I had done some digging into it, and I have to double check what the required threshold is to be a member of that program, but I think it's only 10% of the day has to fall within those execution parameters to be a member of that program. And then, of course, you have an asymmetric distribution between the requirements and the actual benefits that reward big players. But that alone, it when you start to see all of these finer and finer lines being created within exchange fee and rebate structures, it just really details how messy this thing is. And I think that now that you have light being shed on it, there's going to be a lot of revelations that occur that are going to reveal some of the strengths of our markets, but also the quiet but ever so disastrous vulnerabilities of it. Especially when you have internalizers that are reporting, God, I won't name any specific tickers, but some of them have 10x the float being executed within internalizers in one day. You know, like how does that make sense for anybody but the entity that is performing those executions?
Yeah, I mean, I think those kinds of stats, when you see like multiples of the float being turned over in a day, call a lot of things into question in terms of what the underlying mechanics are that are going on.
Right. And then also just the monetary incentive for performing that egregious amount of just back and forth just for the sake of going back and forth. If you look back at '08, you know, one of the major cruxes to the downfall of the global economy was, yes, the liquidity of everything that was being traded, and of course you had some financial instruments that were just inherently, footholds for themselves, but it was the quality of the liquidity. And when you have liquidity just being moved around for the sake of moving liquidity around instead of prioritizing the quality of it, that's kind of like the preface to what can create disaster within markets.
I agree. I think this is a really important point that we're losing diversity in markets when you have concentration like this, and it leads to fragility. But it also leads to this mirage of liquidity. And
that's a good word for it.
There was a good story. Someone was in a meeting with an exchange executive, and they said, "Look, I think we all need to agree and understand that volume does not equal liquidity." And the head of this exchange just started cracking up, laughing, and called the guy straight up to his face an idiot. And he said that's absurd. And yet, you can look at the flash crash as one of the highest volume events in all of markets, and also one of the least liquids.
There was so much volume, though. It had to be good. Markets are strong. Stronger than ever.
I mean, there are incentives to churn in markets, and that churn makes it seem like there's a lot of liquidity, but when you need it the most, you tend to not have it.
Kind of reminds me of like a liquidity filibuster, where you're just kind of moving stuff around just to move it around, such that you're meeting all the marks, but when you actually open up that Pandora's box, you look inside of it, and it's a nightmare. I feel like there's too much liquidity within markets, and I think a lot of anybody who's more understanding of this or at the same level of, as far as market structure and the way that these mechanics all interact with each other goes, they might laugh at me for saying that, but I truly believe there's too much liquidity, because you look at just how much can be moved around in the pairings that are generated with it. Like, we just had a Bitcoin ETF go up, and you've created a direct connection between the crypto market and now the equities market. And then you begin to wonder, well, we know how volatile crypto can be. And I love crypto personally, but just for the sake of argument, let's just consider how much of a wild west it can be when you have different tokens and different coins that are all kind of just moving around. When you start interconnecting these particular coins and tokens to things like Bitcoin, if you have enough influence between that pairing, eventually, if you have too many lack of quality connections like that with Bitcoin, well, now you have a direct exposure from the crypto market within the equities market. And then if you have a particular player, whether it's a big fund or a market maker who has too much weighting within that particular ETF, if for some reason there's a coin that is able to bring Bitcoin down with it, or the other way around, where now that any liquidity pairings that have been generated off of that basis start to tank, well, now you have these players that do have the ability to make markets move who are now suffering because of that. It's a type of vulnerability that I think not many people have parsed and really considered. And I think a lot of it has to do with the way that you have, again, concentration of particular market makers and participants, and the way that they interact with the markets.
I mean, I'm a huge fan of cryptocurrencies. I have been for a very long time. But I think it's insane that the SEC approved that Bitcoin ETF. I think it's insane only in so much as the reasons that they've been denying ETFs have not changed. Like, there's just because it's a futures contract doesn't mean that the underlying market is a regulated market and, you know, subject to the standards of surveillance that they require. So I think that was absurd, and now there is no argument for them to make that they shouldn't just approve every Bitcoin ETF that's ever been approved.
Right.
All right, guys.
You know,
So
Sam,
sorry, guys. Get out.
no, please go ahead. I was just going to continue the conversation. Please go ahead.
Yeah, no, I was just asking Dave a question about something that's in the brief. I wanted his opinion on something about what Citadel said. They make this statement. They draw this analogy. They say, to put it in practical terms, imagine a grocery store that has deliberately installed extra long conveyor belts on checkout lines. After you've committed to buy your items at the advertised price by placing them on the belt, the store uses the extra time required to traverse the belt to determine whether any item that was available at the same price at competitor stores has sold out. If so, the store's computers quickly raise its own price before your item reaches the cashier. You can either pay the higher price, etc. So, Dave, is that a fair?
It's so ridiculous. It's such a ridiculous metaphor. It was as I was reading through the brief, that was like one of my first notes. Citadel opens brief with a really terrible metaphor about grocery stores.
It reminds me of that scene from the interview where they finally go to the supermarket and they realize it's all just plastic fruit.
Right. It's I don't even know where to start with it. It's just completely backwards, right? So it's like, okay, I'm going to buy something, right? And I don't know. I don't even know how to like translate
It's like being
the
in the
D-limit
line.
order type into this metaphor. I mean, it's like, first of all, you're talking about a grocery store where this would only happen like 3 seconds a day. Okay, so first of all, that's what we're talking about. You're trying to tell me this is a material thing when it's only active 3 seconds in a day. It's not like, this is going to happen half the day. And then second of all, you're talking about like the most minuscule repricing of something just because that's the actual price. See, that's the funniest thing about this, is that they're fighting something, they're fighting this order type that is doing its best to reflect the actual price. The price that the order was at before the crumbling quote indicator fires was the right price at that time. But once that indicator fires, it means that it's not the right price anymore. Right? Like, that's the thing. And it doesn't happen hardly at all. But for those couple of seconds a day that it happens, it's an exchange fulfilling its responsibility to make sure that it has a better view of this very complex set of market feeds than the fastest people who are interacting on the exchange.
And just to clarify,
and so,
I'm sorry to cut you off. When you say a couple seconds a day, that's collectively throughout all of the HFT.
Yes.
Right. It sums up to being seconds a day because they're actually executing at such fractions of seconds.
Right. It only fires for a 2 millisecond period at most. Right. So that's what we're talking about.
Which all then begs the question, though, right? So let's make a few basic assumptions, and then we can go off into a fun land of supposition and speculation. So Citadel knows all this. Everything we're discussing, they know. Their lawyers are good lawyers. I wouldn't say that they're Citadel's most expensive lawyers, but they're probably Citadel's second to third most expensive lawyers, right? They're aware of the standard of review. They're aware of the likelihood of prevailing on the arguments of the case. So then let's peel it back another layer and look at what could then the potential outcome, desired outcome, be. If this is a Hail Mary case to begin with, it's going to cost millions of dollars to litigate. So far, it's been in the courts for a year to 18 months. Before this case is over, it will be in the courts, in all likelihood, if there's appeals, for, let's say, conservatively, another 6 months. So we'll have a 2-year arc of a case that was a long shot to begin with. So the question becomes, why? It could simply be, and this is what they would point to and their attorneys would point to, is that this is worth pursuing. that a remote chance of prevailing doesn't mean that there's no chance of prevailing, and we're going to exercise what rights we can to protect retail's interests, apparently. But let's put a pin in that and maybe just look at some of the other outcomes, other implications of the conduct and what resources the case itself, just the conduct of the litigation, are consuming. So in terms of resource consumption, obviously it's taking Citadel some cash. For an appellate case like this, $1 million to $2 million to this level, for this level of lawyers, would be a reasonable expense. But when you're measuring profits in microseconds, and we're talking about an 18-month case, what's the value of that? So you have a minimal expense on petitioner's side relative to their war chest. You have, on the other side, SEC resources that then need to be designated to prepare, research, argue this case. So there's a team of at least 3 on the brief that are 3 of a team of total, maybe 100, 150. So right there, you're having an impact on the number of bodies, the numbers of brains that can look at anything on the market wide, let alone a specific issue that might be another issue that you want to address. And then thirdly, you have intervener, IEX, who arguably doesn't have to join the case. They're an intervener. They chose to join the case, but their rights would be materially impaired had they not. So this is imposing an expense on IEX as well. So by just engaging in this process, in the litigation process, there's already result out of it. And it's something to always consider, because litigation is a practice. Litigation is a tool, especially at a certain level, just like the law. And, there always obviously has to be a colorable and defensible argument to be made. You cannot abuse the court system. That is a very serious thing. But that doesn't mean there can't be multiple motivations simultaneously that are undergoing. And I think with the low likelihood of prevailing here, it's worth exploring.